If you're getting close to retirement or you've already retired, you may have thought about how taxes might affect your financial plan. After all, taxes are probably the biggest expense most of us have over our lifetimes, and retirement is no exception to that. So after working with hundreds of people on their retirement plan, I've noticed a few common tax mistakes that people make, and I've narrowed that down to 3 that I want to share with you today. So let's dive in. Hey everyone, my name is Jake Skellhorn, certified financial planner and co-founder of Spark Wealth Advisors. So the first mistake that I see a lot of people make when it comes to their retirement plan is not understanding RMDs. An RMD is a required minimum distribution, and it applies to pre-tax retirement accounts. So this would be things like 401ks, 403bs, traditional IRAs, and any other tax-deferred retirement account that you may have. Once you turn age 73, the IRS essentially says you have to start taking money out of these accounts since that money has not been taxed yet. This age will go up to 75 in the year 2033. And if you don't take the RMD from the account in the year that it's required, you can pay a 25% penalty of the amount that you should have taken. So obviously, extremely important to make sure that you not only understand RMDs, but take them in a timely manner to avoid that penalty. And if you're nowhere near age 73, you might be thinking, oh, I don't need to worry about that just yet. I'm only 50, 60 years old. But I do want to explain why it's important to start thinking about RMDs well ahead of time. So because RMDs are just that, required, they essentially involuntarily increase your income in the year that you take them. So whether you need that money or not to live off of, you do have to withdraw that, and that money is going to be added onto your taxable income for the year. So that has the potential to push you into a higher tax bracket, which may cause you to owe more taxes than you necessarily need to. The other thing that it will affect is Medicare surcharges. If you're over a certain income in retirement, you will owe surcharges on your Medicare, Part B and Part D. So I'll share the brackets for what's known as IRMA, or Income Related Monthly Adjustment Amount, so you can see where you might land in those brackets and see if you owe any applicable taxes on that. So knowing that we will have an RMD at age 73, even if you're age 60 now, we can reasonably estimate what your RMDs might be based on a given rate of return and your current balance in your IRA. So for example, if you're 60 today and you have $1 million in your IRA, if that IRA grows at a rate of return of about 7% per year over the next 13 years until you're 73, you'll have a little over $2.4 million in that IRA. So the RMD is calculated using your balance as of the end of the year before, and then it's divided by what's known as the life expectancy factor that the IRS uses. I'll put a link to that in the notes here so you can see exactly which life expectancy factor you might use to calculate that. But using this calculator on investor.gov, your RMD will be a little over $90,000 in that scenario. So again, that $90,000 that you will be forced to take out of your account, whether you actually need it or not. So you will have to pay taxes on that, possibly at a higher rate than you normally might if you had a lower income. So in this scenario, if you in fact did not need quite as much money as that to live off of, again, this is not even factoring in Social Security, any pension income or withdrawals that you have from other accounts, then that $90,000 may put you into a higher tax bracket unnecessarily. So same thing, Medicare surcharges, they could owe more than you need to pay in Medicare surcharges. So one solution there is to that is planning Roth conversions ahead of time. When you convert money from a pre-tax account to a Roth IRA, you're essentially reducing your balance in your traditional IRA, which is going to then reduce the calculated RMD amount. So, if you convert parts of your traditional IRA to Roth IRA over those years before your RMD, then you will essentially have a lower RMD when that time comes. So rather than taking out $90,000, you may, in theory, only have to take out $60,000 as your first RMD. So that could mean the difference in thousands of dollars in taxes that you have to pay by planning ahead and making those Roth conversions. Now, just keep in mind, Roth conversions are taxable in the year that you do them, so it may or may not make sense in your situation. So when you convert money from a pre-tax to a Roth IRA, you'll pay income taxes at whatever marginal bracket you're in that year. So there are some scenarios where that doesn't make sense. For example, if you're still working, you're probably going to be in a higher tax bracket than you are in retirement. That's for most people. So if you are converting traditional to Roth in a year that you're in the 32% tax bracket, but you only expect to be in the 25% tax bracket in retirement, then it may or may not make sense to do so. So that's something that we look at for all of our clients to see what the outcome would be of those Roth conversions. And taxes is not the only consideration here. So we definitely want to make sure that you are projecting your annual expenses properly and not just converting everything to Roth because it's going to be tax-free later. So important to look at your individual situation when it comes to Roth conversions. And again, for the same reason, Roth conversions can also reduce those Medicare surcharges. So IRMA is based off of your income as of 2 years before. So this just reinforces the fact that it is important to plan ahead. So when you retire, say at age 65, if you want to start taking Medicare right away, it'll look at your income in the year that you were 63. So obviously RMDs aren't for a few more years after that, but it is important to consider Roth conversions, maybe to keep you under a certain income level to avoid paying the next tier Medicare surcharges. Second mistake I see people make a lot is not understanding that Social Security income can be taxable. A lot of people think that Social Security benefits are tax-free. Unfortunately, this is not always the case. So there are certain thresholds that if you make more than that in combined income, then your Social Security benefits can be partially taxable. So I'll put those numbers up on the screen now so you can see what your combined income would be before that Social Security benefit is taxable. So there's a threshold where there are no taxes. As you can see, it's a pretty low threshold. Then there's the next threshold where about half of your benefit will be included in your taxable income. And then the highest one can be as high as 85% of your benefit is included in your taxable income. And just to clarify, this does not mean you'll pay a 50 or 85% tax rate. That's just the amount of your benefit that will be included in your income when it's used to calculate your tax liability. And to calculate this, again, this is called your combined income, or also known as your provisional income. So the IRS uses this number, which is your adjusted gross income, which would be things like IRA withdrawals, pensions, taxable income you might have from a business or rental properties. Then you're going to add in any non-taxable interest that you might receive from things like municipal bonds or anything that's normally not taxable on your income tax return. And then you'll add half of your Social Security benefit to arrive at your provisional income for this calculation. So one solution to minimize taxes on your Social Security benefit would be to delay benefits. A lot of retirees experience what's called the retirement spending smile. That just refers to what your spending might look like on a chart. As you start retirement, your expenses are generally fairly high. You on that high of retirement, you want to travel a lot, spend a lot, maybe more money eating out or spending time with family. Expenses typically start out relatively high, and then they lower as you settle down in retirement, where you kind of settle in and reduce vacations a little bit, more of a the day becomes a little bit more relaxed. And then as you age, medical issues will cause those to increase a little bit more towards the end. So that's what's known as a retirement spending smile. So knowing this, you can delay Social Security benefits in the earlier years when you think your expenses may be higher and your income may be higher to support that. And not only does that reduce, what your taxes will be since you're not drawing Social Security right away, but delaying your benefit can also increase your benefit amount when you do claim it. So this is one way that you can reduce or minimize taxes on your Social Security benefit, again, just by delaying when you take it to those years when you may not need as much income and thus will be in a lower tax bracket. And of course, taxes are not the only consideration here. If you determine that you do need to draw Social Security early or earlier than full retirement age, then go ahead and draw that Social Security. You don't want to be living off of ramen noodles in retirement just to save money in taxes later. Again, it's all dependent on your unique situation. With that said, if it does make sense for you to delay benefits, you would essentially just live off of other investment accounts in the earlier years of retirement. So you can do withdrawals from an IRA, a taxable brokerage account. If you have other pension income that would support your living expenses for the first few years, then that's where you would draw that income from rather than Social Security. By the way, if you find any of this helpful, go ahead and just like and subscribe for me. Maybe leave a comment if you have any questions or if you have any ideas of any other videos you'd like me to do. We definitely appreciate any subscribers because this helps us grow our audience and help more people out there like you. So thank you. The third mistake I see a lot of retirees make, and maybe the most important one, is not having a tax-conscious withdrawal strategy in retirement. Most retirees will have a mix of both pre-tax, Roth, and then taxable brokerage accounts to withdraw from in retirement. So that's 3 different tax buckets, I like to call them, that you can withdraw from. Each account has a different tax liability when you liquidate investments from it and withdraw that money. So the order in which that you take money out of those accounts to satisfy your living expenses can have a huge difference on your total tax liability in retirement. So, for example, when you sell investments in a brokerage account, you'll typically pay long-term capital gains as long as you've had those investments for over a year. And those are taxed at favorable rates. Those can anywhere from 0, 15, or 20% depending on your total income. Your pre-tax accounts, of course, will be taxed as ordinary income, which is generally your highest rate in retirement. Then your tax-free accounts like Roth will not have any tax liability as long as you've met those conditions of 59.5 and having the account open for at least 5 years. So again, deciding how much to pull from each account and in what order can have a huge impact on how much taxes you pay, not only in the current year, but in your lifetime in retirement. So the inclination typically might be to take a little bit out of each account so that you don't deplete any one account quickly over your retirement. But you can see in the example that I'll show in just a minute that this may not be the best route. That's known as a pro rata withdrawal. You're taking from each account proportionally. But if you do a certain order in the example that I'll show you, you can see how it can impact your total balance over the life of your plan. So let's take a look at a client example just to see the impact of a tax-conscious withdrawal strategy compared to a pro rata withdrawal strategy. So this is information from an actual client of ours. We'll call him John. John's information has been redacted just for security reasons, of course. But John is still working for another couple of years. He's currently 65, plans to retire around age 68, and he wants to live off of about $12,000 of monthly income to support his desired lifestyle in retirement. He currently has a little over $2 million in a couple of accounts with us here. He has a traditional IRA and a brokerage account. Doesn't have any Roth IRAs. We may explore that later, but we have not factored that into this plan just to keep it simple and look at the effect of the withdrawal strategy only. So here's the default, which is that pro rata withdrawal strategy where he might expect to pull money evenly from his brokerage account and his IRA as he starts to need that income in retirement. And this is going to be our proposed strategy, which is where he would pull everything from his taxable account first, his brokerage account, and then once that is depleted, he'll start withdrawing the money from the traditional IRA second, and then finally any Roth IRAs he may have down the line. So this chart here just shows you the expected impact of that withdrawal strategy versus pro rata. So as you can see, over John's life expectancy, this can result in over $1 million more that he gets to keep or pass along to beneficiaries and not pay in taxes. So just wanted to show you an example of exactly how much of an impact this can have. And we love to show this page to clients just so we can kind of quantify exactly how important it is to withdraw in a certain order as opposed to, pro rata strategy. So another screen that we just like to show here is the actual federal tax liability that's expected. So always nice to see a much lower number than what you normally might have expected to pay with that pro rata withdrawal versus the taxable account, tax deferred, then tax free. So again, just wanted to show a real life example of this withdrawal strategy just to show the overall impact that it can have. This obviously assuming certain market returns, life expectancies, things of that nature. It's by no means guaranteed, but it's definitely something that can have a big impact on your overall balance in retirement. Developing a tax-efficient withdrawal strategy from your various accounts in retirement is probably the most complex out of the three solutions we've discussed to each retirement tax mistake, but the juice can definitely be worth the squeeze, as you can see. So because it's so dependent on your different balances in the various accounts and what your income needs are going to be, what the expected returns will be of the portfolio, it's definitely very dependent on your unique situation. So between required minimum distributions, Social Security taxation, and a tax-conscious withdrawal strategy, taxes can have a huge effect on your retirement, as we can see. Start by assessing what your needs are going to be in retirement and how RMDs can supplement those income needs. If RMDs end up being more than what you might need, it may make sense to look at a Roth conversion strategy well ahead of retirement. Same thing with Social Security benefits. You want to see what your expected benefit may be, and if you'll really need that in the early years of retirement, or if you can live off of other investment accounts for the first few years. By delaying your Social Security, again, you can not only get a higher benefit, but possibly avoid including that benefit into your taxable income. And lastly, a proper withdrawal strategy in retirement can mean the difference in hundreds of thousands of dollars in taxes over the life of your retirement. So it's definitely important to look at all three of these when considering your retirement plan and minimizing your taxes, which will keep more money in your pocket and more money for you to spend in retirement. So thanks for joining me today. If you have any questions, feel free to leave a comment. I'll be sure to get back to you. And if you'd like to check out more about what we do for our clients, visit us at www.sparkwealthadvisors.com.